This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you'll find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means that you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Alex's picture that says Looking for the Downloads. Now, Nick, let's get to talking some charts. On page 2, we have the S&P 500. Let's start with you. What levels are you watching now that the S&P 500 is broken to the upside here on the post-FOMC?
Yeah, Patrick, that was quite a move we had yesterday. Beautiful move to the upside. So right now, as I speak, spot is around 4150, 4160. Expected move again for the February 17th OPEX is about 110 points, so about 2.65% other direction. Upper expected move there is 4260. With strong resistance now broken at 4,000 and the 4120 resistance broken as well. Those should act as support. If we break back below them, obviously, you can flush back down. The lower expected move is 3940, and support again is at 4,000 now, then 3,800, then 3,700, then the October lows acting as very heavy support at 3,500 or so. Now, Eric, what are you thinking about the S&P right here?
The FOMC statement took the S&P back above 4150, which is the 50% retracement point of the big move down from 4,800 down to the bottom. Now, the only time since the market bottomed that we've gotten up to this level was the CPI print a month ago, but December 12th CPI was just an intraday spike that very quickly retraced. What we saw here was only a very small amount of retracement after putting in the high of the day on Wednesday. As of Thursday early morning before the open, we're still holding, as I speak right now, 4151 on the S&P, just about on that 50% retracement number. So big picture, it seems to me there are three possibilities here. Number one, this is a bear market rally that fails right here around the 50% retracement point. Scenario number two, this is a bear market rally that fails at or near the 61.8% retracement level, which is just above 4,300. Or scenario number three, the bottom is already in and we really have somehow magically achieved a soft landing and the market's headed back towards all-time highs from here. That's not at all my base case. I'm thinking number one or number two, but I really don't have a strong opinion on which, whether we're done here or going to go up to 4,300 before we're done. We'll see what happens.
That's an interesting take, Eric. What I was watching here was whether or not the central bank meetings were going to actually be a catalyst for potentially changing the trends in this market. And at least initially here, that has not been the case. The upper levels that we were looking at for potential testing was that December high here around just under 4,200, as well as that August high close to 4,300. At this stage, testing those overhead resistance levels seems the path of least resistance. But the bigger question is that, well, if now that we're past most of the earnings and past the central bank meetings, if the market hasn't turned on that, then will this prevailing trend persist in the weeks to come? And is this the story for the month of February? I mean, inevitably, there will be a point where the market will have to check this rally and then we're going to have some sort of a sell cycle. There just seems to be no evidence at this moment that this is imminent. This trend is persistent, and we have to first see where the upside exhausts itself before we speculate on short-term downside targets. One of the things that I'm going to be really watching closely is when we inevitably get a dip, how well will the bulls defend it, and where the support lines will come in on that. And those are certainly some of the key things to watch. Now, moving on here, Nick, I have the QQQ NASDAQ on page 3, and it broke that December high and certainly has come to life. What do you make of this?
Yeah, so as we were saying before, this rally is pretty strong. And I mentioned last week that I thought we'd touch that 310 area, which is there's a gap fill on the chart from September-ish. at 310. I believe it's like 84 or something like that. And we're almost there right now. We're at 306 as we speak. So again, looking at the February 17th OPEX, we see spot Qs 306. Expected move is about 12 points in either direction, which is about 3.9%. Now, keep in mind, we've already had Microsoft report, which was pretty poor overall. Tesla beat on the top and bottom. Free cash flow came in a week. Meta came out last night, beat on revenues, light on EPS, but they issued a $40 billion buyback, and that was a huge salvo to the bulls right there. It's up 20% as we speak right now, which is a crazy move for a company as large as Meta, right? Tonight we have Amazon and Google, so that should dictate where we finish off the week. But as of right now, that 310 area is what I'm looking at. Beyond that would be 320, then 330, obviously, which are the previous highs from September and August. Now, right now, the expected move, upper expected move for February 17th is 317.50 or so. And the lower expected move right now is 393.50. Keep in mind that now, if we hold this level, the previous resistance of 296 should act as support. So that should be support followed by 280, 260, and then 254, which are the October lows.
All right, let's talk volatility here, Nick. And one of the interesting things on page 4, I have that chart of the VIX, is that we have now broken all of the 2022 lows. I mean, there was on the first days of January of 2022, some of the low prints actually near 16.5. But we're now in the territory of heading back to 2021 lows on the VIX, which were actually when the market was still in an uptrend. I'm finding it actually quite surprising how low volatility has collapsed here. What do you make of all this, and what levels are you watching?
Yeah, so I'm always watching the VIX, and seeing it break that 18 level, I don't know, it's very surprising overall. But again, these bear market rallies can last longer than expected and can burn a lot of the bears in the process. I've noticed a lot of people that I've been speaking to have been shorting the market here, and it hasn't worked out too well for them overall, right? So the spot VIX is about 17.6. Expected daily moves in the broad markets are about 1.1%. And as you mentioned, we're seeing the lowest levels in the VIX in over a year. However, it's important to remember that when we look at the charts of the VIX and it bases at the lows, it typically breaks back to the highs pretty fast, within a month or so. So as you were saying earlier on our discussion on the NASDAQ, it's possible that we do get a pullback at some point. It could be a very rapid pullback, and that could cause the VIX to spike as well. But again, the trend is your friend, and you got to watch the VIX and the S&P and the NASDAQ and see where everything is going, essentially. Now, moving on to page 5, we have the US dollar, which broke to a new low post FOMC. What are your thoughts here, Eric?
Well, Wednesday's closing print looks ominous, to say the very least, like perhaps a new leg lower in this dollar correction or dollar bear market as it's turning out to become. But FOMC days are also infamous for creating head fakes that reverse within a day or two. So far, it hasn't reversed as of early Thursday morning, but let's wait this out and get a few more closing prints in before we decide for sure that we have a new leg lower in this move down on the dollar.
Yeah, it is actually really interesting that the dollar broke to a fresh low. It's not that the trend that is not going to remain in play, but usually such an overextended move in the dollar often has some form of a reaction, some mean reversion, some sort of a bounce, just to check the decline in the dollar. And this seems to continue to be incredibly persistent. I mean, this continues to be a tailwind for so many risk assets. And really, if this continues down towards the bottom end of 2022 lows, that would continue to actually feed almost all of the different risk markets to continue in the prevailing trends. Right now, one of the things that I'm going to be watching is in the post-ECB period, whether or not things like the euro can advance meaningfully north of 110 and hold it, just as further evidence. I think that we really just need to see how all these currency markets settle down, as all these major central banks have all just been releasing. But if this trend is still persistent next week, we're going to have to ask some very important questions as to what's next here for many of these different markets.
Let's move on to gold on page 6. Now we're nearing that 2000 level, which I've been eyeing for a while now. What are your thoughts here?
Well, you got a nice chance to buy 1915 before the Fed sent it all the way back above 1970. And Alex isn't the only one who sees the possibility of this cycle taking us all the way up to 3000. Saxo Bank said the same thing in their outlandish calls piece at the very beginning of the year. It feels overdue to me for a more substantial correction, but frankly, it's felt that way for the last $100 of upside, so I won't hold my breath. Something I've been thinking quite a bit about is how badly gold mining stocks are lagging the price appreciation in the metal itself. I asked the CEO of a major gold mining company about that this week, and he told me that the word he hears is there just haven't been many inflows into the funds that hold most of the gold mining shares. One possible explanation is that retail traders are just too beaten down by the broader bear market in stocks to ignite a meaningful rally in mining shares. But central bank buying, meanwhile, is driving the cost of the metal up because, of course, central banks don't buy mining shares. They buy the metal. And it's speculative investors who want the leverage that they get from buying the mining shares who tend to buy the stocks. So it certainly makes an argument that the mining shares are the better buy here and that they will eventually catch up, especially if it turns out that my third scenario is right and we really have seen the bottom of the stock bear market. I think that's unlikely. But if it were the case that we're headed to new highs in the S&P and we're going to get an economic recovery from here, then certainly there's a long way to go for the miners to catch up to the metal here. And of course, it also invites the possibility of a pairs trade, although frankly, shorting gold against long mining shares seems like a pretty risky move right now, given the momentum that we're seeing in gold.
Yeah, for me, the interesting thing was is that as we approach 1900, which we're now decisively above, it was an important level because to me, that's where if the gold was just simply oversold and just bouncing and retracing much of its prior decline, then we shouldn't have seen any meaningful progress above 1900. But it's been quite the opposite. Gold has not pulled back at any stage, continues to get tailwind from the weakening dollar and has now consolidated for many weeks above that 1900 level, which continues to demonstrate that the bulls remain decisively in control of this trend. Obviously, Nick, you were referencing those previous highs, obviously resistance at 2,000 and somewhere just above 2,500. Those all become very realistic short-term upside targets. But at some stage, that resistance will cause the rally to be checked. And it will actually be the way that gold consolidates from there that will be the real tell as to whether or not fresh 52-week highs are imminent. Interesting thing is silver as well has been consolidating for several, almost a month now, and is just trying to break out. And that would certainly be something that would be a confirmation if we started seeing almost all the precious metals all engaging into another new advance. It'll be certainly interesting to see if that plays out in the coming days and weeks. Moving on page 7, though, I wanted to just comment on crude oil. I know, Eric, you talked about it earlier at the start of the show, but one of the things I was watching was whether or not that $82 level could be beat. And while crude oil was progressing off of its lows and a couple of solid pushes higher, it hasn't been able to get back into those key trade ranges that were being established in the second half of 2022 in the mid 80s. And so this pattern of that downwards channel of crude oil remains intact. And while I understand the bullish angle on oil, and in fact I am always looking to see when a new bull trend can begin, if for whatever reason this weakness that we've seen this week remains unchecked, it continues to verify that crude oil is not done its sell cycle. Will that cause a retest of the lows or even a shoot down into the mid 60s to test some previous lows is something that we'll be eyeing when inevitably crude oil turns into its next bull market, it will be a significant technical and macro event. But at this stage, the chart just continues to be incredibly weak, and no sign of that bull that we've been looking for as a start. The last thing, though, on page 8 I wanted to just show was that 10-year Treasury Futures. I know we usually look at the yield, but one of the interesting things is that on the post-FOMC, that little flagging formation is trying to bullishly break out. The question here is, are we going to see some new impulse of the Treasury bonds running higher and yields getting pressed down? It certainly looks like a breakout. One of the things we'll be watching into next week is whether or not this breakout sticks and whether we see a fresh multi-week high, which could send the 10-year Treasury note futures up towards 118 to 120. Certainly a trade that I'm going to keep my close eye on.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the chart deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.